The S&P 500 as well as the NASDAQ are going quite parabolic today. S&P 500 up 2.38% at the time of recording this video, as well as the NASDAQ is up 3.5%. All of this rally comes based off of one quote from Fed Jerome Powell. He says, "Don't expect moves of today's size to be common. 50 basis points to 75 basis point hikes are likely at the next coming meeting." So essentially what the markets were looking forward to, or hopefully not looking forward to, was the Fed to confirm those 1% rate hikes if those are going to be coming into the future. And he did not. So that's when the markets took this big candle, and that's when you've seen that very, very bullish reaction. Now, a lot more was actually said, and we need to talk about, is this rally actually going to last? So we're going to dive into it. We're going to talk about our favorite stock here in this video as well. But in the meantime, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Get your free stock with Webull, Mumu, and Public down below in the description, as well as come join the trading community if you guys want to be a part of that action. Link down below in the pinned comment and the description of this video. But let's talk about what Fed Jerome Powell said, some of these quotes that are coming out and hitting the news wire. So Powell says, if you're a young person looking to buy a home, you'll need a reset, and he means interest rates going up, so prices will eventually come down. Powell says need to get housing market supply demand balanced, says housing market is still very tight. And then he says FOMC not sure how much policy will affect housing market. FOMC is watching mortgage rates. He says market seems to be okay with QT, which QT is reducing the size of the balance sheet. That started on June 1st, but QT takes a while to actually go into effect and to actually see the effects of that. So I think it's really a immature comment to say, in the sense of we have not seen what policy is going to be affected by QT yet. We've never done QT, so I don't think you can logically say that the markets seem okay with QT. We really haven't seen what effect that will have as of yet. He says, we will look carefully at why inflation proved persistent. Said, this is an extraordinarily uncertain environment. Says, the federal funds rate somewhere in the 2s by the end of summer. He also says fluctuations in commodity prices could take the possibility of a softish landing out of our hands. Powell says, want rates at restrictive level of 3 to 3.5% by the end of the year. He says inflation is a very unpopular thing, painful for people. Powell says people don't like this inflation. We understand that. Yes, thank you, Fed Jerome Powell. It says the public's confidence in FOMC achieving price goal is critical. And there's a lot of other comments, and we're not going to read through all of them, but he was basically saying, and he was asked about a soft landing, if they still expect that, and if they have to actually see unemployment rates going up to get inflation to go down. And he said essentially that that would help a lot, but that's not what they're trying to do. They don't want to see people out of work. They don't want to see the economy getting bad, but it looks like a softish landing is off the table as of right now, and the NASDAQ down 30% for 2022 so far. I think that softish landing is really done. It's gone. You're not getting a softish landing. 30% down in 6 months is not soft, or it's not soft-ish. So they did say as well they do expect a 4.1% jobless rate by 2024, and that's really one that's kind of weird as well. I think the unemployment rate is going to be higher than that if you keep seeing companies coming out and laying off, like good old Elon, 10% of their workers, and a lot of other companies that are also starting to come out and do that as well. Now, if we look at CNBC and look at the main headline right here about the Fed rate hikes, it says Fed hikes its benchmark interest rate by 0.75 percentage points, the biggest increase since 1994. The Federal Reserve raised its benchmark interest rates 0.75 of a percentage point in its most aggressive hike since 1994. According to the dot plot of individual members' expectations, the Fed's benchmark rate will end the year at 3.4%, an upward revision of 1.5 percentage points from the March estimate. Officials also significantly cut their outlook for 2022 economic growth, now anticipating just a 1.7% gain in GDP, down from 2.8% for March. And that's what we've been talking about as well. The Fed in March expected growth of 2.8% GDP for 2022. Now they only expect a 1.7% gain. I don't know how the markets are going to take this. It's down 1.1%. In just 3 months. So it's definitely a very downward trajectory of growth expectations, but the markets are seeming to rally off of this. Now, I still think you're going to get more upside pressure from the bond rates overall. If we look at bonds, the yields have actually dropped 0.13 basis points as of right now since Fed Jerome Powell did come out, and that is what is giving us the boost to stocks today, and especially after this Fed meeting. But I don't really think this is something that's going to last over the next couple of days. I think the digestion of this Fed meeting is likely to be one that is pretty bearish, because the Fed is basically saying, hey guys, we're going into recession. We're going to continue to hike rates. There's no way the 10-year yield can stay at 3.34%. There's just absolutely no way that can happen. So you're going to see rates that go up off of the digestion of this, 50 basis points, 75 basis points back to back. It's just simply put, no way that rates can stay at 3.34%. And that's probably going to push some downside pressure onto the stock market like it typically does. But nonetheless, remember what happened the last Fed meeting. The markets, just like it, very similar to today, the markets after Fed Jerome Powell, they rallied about 3% to close out the day on the NASDAQ as well as the S&P 500, which the NASDAQ right now is almost at 3%. And then what happened the next day? Well, the markets dropped like 6%. It was not a good day at all in the markets. I believe this is the day right here. Markets were up 3.38%. This was May 4th, the day of the Fed meeting. And then what happened the next day on the NASDAQ? We ended up closing the day down 5%. So it looks eerily similar to something that we've seen back here in early May. I'm not a fortune teller. I don't know if that's going to happen, but I do think there is a lot of bad news that came out of this. Even Fed Jerome Powell was a bit shaky, and I know you're going to hear some people saying that. I think he was pretty nervous for this press conference just because of how negative and how much things have really changed since the last meeting. It's not a good thing. Just overall, it's not a good thing. But this is probably a shorts covering kind of rally, at least for now. But long story short, the Fed meeting today showed that if data changes, if the markets start to price in a more hawkish Fed or a more dovish Fed, that's what the Fed is going to do, no matter if you only have 2 or 3 days to digest that change, right? The CPI report came out on Friday. By Monday, the markets were expecting a 75 basis point rate hike. It went from a 3% probability of getting a 75 basis point rate hike to a 97% probability of getting a 75 basis point rate hike since Monday. Not last Monday, this Monday that just passed, ladies and gentlemen, 2 trading days ago. So it really shows that the Fed is being dangled on a string by market expectations. So the data that we get from this point forward is going to be very, very important. Now, we did get retail sales that came out today, which did show that for the month of May, retail sales were down 0.3%. We were expecting a 0.1% increase. It did show that more people are spending money at gas stations, but not spending as much money on other things. And that is what we've been highlighting here on this channel. That is what is going to push us into a recession, if not possibly a depression. Now, at the same time, the federal funds rate for July 27, 2022 is pricing in another 0.75% rate hike with a 94.2% probability of doing that. 50 basis point rate hike is pegged at about a 25.8% probability for that. So we'll see what happens with the rate hike probability. That's going to be probably the most important thing, because obviously the Fed is going to follow what the markets are pricing in and what the markets are expecting. But like I said, any other data point will be very, very important. And what do we have for data coming out tomorrow? We have housing starts for May, building permits for May, initial jobless claims, some other bond auctions, things like that. Nothing too crazy. And then on Friday, you have Fed Jerome Powell that speaks again, 7:30 in the morning. Industrial production year over year, industrial production month over month, manufacturing production, capacity utilization, and a couple other things. But overall, that is it. That is the big catalyst for this week. I would watch for that downside pressure potentially coming over the next couple of days. That is what happened at the last Fed meeting, and that is probably what we're going to see in the next coming days, just because we're seeing a 3% rally off of the Fed in the NASDAQ, and it was really bad what the Fed said. Like, it was not good. This was the first 75 basis point rate hike in like 40 years. So just keep that in mind. I wouldn't get too hell-bent on one direction or the other as of right now. It could go either way. The NASDAQ is down 30% year to date. After this move, I believe it's only down 29.29%, but given what we're currently faced with over the next coming months and potentially coming years with Fed policy, there's a long road to go, and I think there is potentially more downside left to go. Something else that I do want to point out as well is that hedge fund selling was never more furious than over the last 2 days. This article came out yesterday at 11 in the morning, and it does say that this is the highest level of selling we have seen since April 2008, when Goldman Sachs prime broker started to track that information, as well as the obviously the biggest dollar amount of selling that we have seen in a very long time, if not ever. But on top of that, hedge funds are getting shorts. Or the short sales are climbing aggressively. So I don't necessarily think we're all free and clear as of right now. We didn't really get anything that was like substantial enough to say, hey, you know, this situation's getting a lot better. We're in the clear. We didn't get that. So that's it. Now let's talk about our favorite stock, which is obviously AMC, and AMC stock is up about 8% here on the day, sitting at $12.84 per share. The fact the markets actually did rip after the Fed is a very bullish thing for AMC stock. And why is that? Because shorts have been putting on those aggressive shorts, a lot of selling activity. If they do have to, you know, cover on some positions, if that is in their strategy, then that is essentially what would be happening today, as well as maybe some additional bullish positioning. Now, you are seeing a lot of puts that are starting to come through as of the last hour or so, the 12.50 as well as the $12 puts for June 24th that are coming through. Positive order value for the day of about 71%, so that does look incredibly bullish nonetheless for the day. Now, let's go ahead and take a look at the short interest. And we can see the short interest is at almost 23%, sitting at 22.92%. Current shares that are sold short of 118.14 million shares. Cost bar minimum 0.35%. Cost bar average 20.14%. Cost bar maximum at 33.01%. Days to cover sitting at 3.76. Cost to borrow at 11.60. Shares out on loan 195.18 million. Free flow out on loan at about 38%. So there is a lot of shares that could potentially be used against us. So just keep that in mind. We're not in the clear. We're not all free and clear. There is shares that can be used against us, and that is a very big possibility. Now, if we do continue to see a bullish reaction, we do have a lot of option activity that essentially could push us up a lot in a very short amount of time. So you have 367,000 calls that are still out of the money and 119,000 puts that are currently in the money. All in all, that's about 50 million shares potentially the market makers would have to hedge for if all of the puts went out of the money and if all of the calls went into the money. Now consider if we do see a 25 to even 30% rally here in the next 2 days or so, if half of these calls went into the money, half of these puts went out of the money, which is very, very possible. If we do get that continued bullish reaction, that's about 25 million shares that would have to be hedged and essentially bought by the market makers. Today, you've only seen about 2.5 million shares so far via the option activity that had to be bought by the market makers and essentially de-hedge for on the put side and hedge for on the call side. So I think that is pretty exciting. But again, it could go either way. I'm still with a bearish tilt here. It wasn't good what we got. It wasn't good what we got. Just because the market is taking it better than some people expected does not mean jack shit when it comes down to it. Just to be honest, over the next couple of days. Now, like I said, stock is trading at $12.81 per share, firmly in this range that we have been in between about $10 and $15 per share for the last, call it month and a half, 2 months. And now, if we can break above the 50-day moving average at 1454, that's going to be very bullish. Likely break above the 100-day moving average as well, and then the 200-day moving average. It's possible if we do get a gamma squeeze throughout the rest of this week, that is a likely scenario given all of the option activity that we are currently seeing. The RSI is at 48.57, pretty neutral overall. The MACD just went bearish. So everything is looking good as of right now. I think we're on the right path to getting what we want to see, which is the MOAS, but it's going to take some time, especially when you're in this very volatile market where nobody really knows where stocks should be trading or what should be happening on a day-to-day basis. It's really all down to those computer algorithms. So that is going to be all for this video. Hit that like button and subscribe to the channel if you guys found value out of the video. Get your free stocks down below in the description, and you want to come join the trading group, link down below in the pinned comment. Thank you guys for watching, and I will see you in the next one.